We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Paul Allen with Rebecca Choong Wilkins.
Good morning. Our top stories today. Investors enduring another volatile session as worries swirl around the looming reciprocal tariff rollout. US shares closing out their worst quarter compared to the rest of the world since 2009. President Trump says he's not worried about his trade war potentially pushing allies towards China, arguing tariffs could actually help traditional US trading partners. And the US sanctions more Hong Kong officials, including the Justice Minister, in what the city government calls despicable behavior. Good morning. You're watching The China Show. Very happy Tuesday to you. A quick look at market action now, and Bloomberg's Avril Hong is standing by for us.
Yeah, Rebecca, I mean, I'm running out of ways to say tariff uncertainty, right? But that's really what the overhang for markets is as we tick down to April 2nd. I think that is the continued heavy weight for equities. And even though we saw a late session rebound in U.S. hours, U.S. futures are pointing to yet more declines. And don't forget, this was their worst quarter versus global peers since 2009. For the dollar, it was their worst start to a year since 2017. So keep that in mind, even as we see a slight bounce in some of these Asian equities. We do have a central bank decision as well out of Australia. Does the tariff uncertainty and the impact on potentially inflation constrain the path of central banks, not just G10s, but emerging Asia as well? You're seeing the yield on the Australian 10-year at 4.41. Now flip the board, because it's not just about April 2nd. 24 hours before that, don't forget, we also have a review of the U.S. Phase 1 trade deal with China. So that continued uncertainty, and some of these U.S. futures were pointing lower. We're seeing a bit of the opposite when it comes to China. We also had the likes of Morgan Stanley, interestingly, saying that given the reciprocal tariffs on a relative basis potentially affecting economies more outside of China, they're saying to add on to offshore China stocks. So keep that in mind. We're seeing the currency holding out relatively stable, 7.265 there against the greenback. Paul.
All right, thanks, Avril. Well, President Trump, of course, set to unveil country-based tariffs from Wednesday, and he told reporters that he'll launch reciprocal tariffs on all countries, but he promised he'd be kind to them.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
All right, Bloomberg senior editor Derek Wallbank joins us now. So, Derek, President Trump there saying he'll be nice, he'll be kind, but what exactly does that mean in practical terms, particularly, say, for automakers?
Well, Paul, I'm not sure that I can tell you exactly what number the word kind translates into, but the White House has been very clear that as much as it thinks that the U.S.'s trading partners, particularly its 15 largest trading partners, have been ripping it off for the last many years, Trump has said that whatever that calculation comes to, his total reciprocal tariffs will not meet that amount, at least initially. We are not seeing plans right now for something that would meet the most maximal of what had been his threats, a sort of line-by-line tariff on every single thing that comes through. But instead, this looks like it's going to be a little bit more general. Trump has been clear that he says that this is going to start with all countries, not just some of them. But at the same point, there should be some ways for countries to be able to use this as the start of a negotiation, to be able to sort of work from there. At the same time, you mentioned autos. Autos are one of the many sectors that are trying to figure out ways to find carve-outs, to find ways to avoid having retaliation or to limit the scope of that retaliation. We've certainly seen that from sectoral sides. We've also started seeing that from some of Trump's allies. I'm thinking particularly of some of the farm states who remember when Trump had to go give some amount of help to farmers in his first term who are sitting there looking at this next action in his second term, wondering what help might come their way should there be retaliation against American agriculture. Because keep in mind, what we've heard from a lot of countries, even though we don't really have a great sense of where retaliation may come or how quick it may come or in what ways, we have started to see early on in this second term that countries have been looking to target their retaliation specific to Trump states and to Trump voters. There are many ways to do that. Agriculture is one. Trying to take Kentucky bourbon off the shelf is another one. You know, we're going to see a lot of those sorts of ways, but it does look like countries are looking to see how they can maybe target this to maybe inflict maximal pain as and when they do decide to retaliate.
Derek, I mean, the other deadline that we're watching here, particularly when it comes to China, is this review, this 2-month review of the Phase 1 deal that happened, of course, during President Trump's first term in office. What are we expecting to learn from that review, and how is it going to be used? I understand it's unlikely that we see that in full, for example, coming through this week.
Yeah, well, Rebecca, I really want to get hands on it and see it. But as you quite rightly note, I don't know that we're going to be able to get that. Maybe we will. Maybe we won't. Maybe we'll get it described to us in vague terms. But this is going to be a review of whether or not the U.S. sees China as meeting its obligations. Now, there is, if you sort of look at different ways of tallying this up, and where, you know, who's to say what the U.S. will do, but different ways of tallying this up, you would see that China maybe hasn't quite imported all of the things that they have said that they would. I saw one number that suggested somewhere in the 60s percentile wise, but there are a lot of things that are sort of sidelined to the U.S.-China relationship when we would be talking about the potential for a maybe next deal, for maybe future negotiations. This is certainly one of those things. Others of those things would be TikTok would be right at the start of any of those lists. Also, the Li Ka-shing deals with regards to Panama and port infrastructure and things of that nature. There are many different things that could be sort of either individually or together brought round as context for starting some of those conversations, which very much have not started, but could be brought in together should the Trump administration want to bring them in together. Because look, you and I have been covering this for a very long time, right? And one of the things that we've noted with Trump and with China is that the main thing is the main thing, sure, but there's also any number of these ancillary items that happen to be coming around that could play into those. And whether or not China has been keeping to the terms of that first deal, certainly in the U.S.'s eyes, certainly in Trump's eyes, would be absolutely material for any sort of future conversation.
Yeah, I think that's right, question. Like, we've sort of been looking very closely also all these potential wild cards that are sort of surrounding this that could be used as leverage or various forms of negotiation as we head into a potential deal between the US and China. That's Bloomberg senior editor Derek Wallbank. And keeping on this theme, of course, about tariffs that we're expecting to come through, the really sort of fundamental way in which Trump is reshaping global supply chains and trade patterns. Let's bring in Ajay Rajadhyaksha, global chairman of research at Barclays. You recently did adjust quite significantly your assessment of the base case for what happens with tariffs.
That's right.
What are you now expecting, and what's the sort of logic behind that?
So coming into the year, we were expecting 30% tariffs on all Chinese goods and about 5% on the rest of the year, rest of the U.S. imports. It wasn't terribly scientific, but if you remember, during the election cycle, the president kept calling for 10% blanket and 60% on China. So we basically split the difference, took half of that. And then we realized a month and a half into this term that the administration was going to be considerably more aggressive than we expected. So at this point, we are putting in 30% on China, still roughly where we are right now, but an average of over 10% on the rest of the world. That means the average tariff on all U.S. imports now, Rebecca, rises to 15%, which is pretty significant. I mean, remember, coming into the year, we were at 2% tariffs on all U.S. imports. That 2 has now gone up 8-fold.
That is a pretty significant from where you were, but it's still a ways below, for example, 25% on Canada and Mexico. So if we see that at that upper end, the worst case scenario, how is that affecting what you're currently forecasting for global growth and for US growth?
We're going to end up being too optimistic, and we are not especially optimistic to begin with,
right.
But you're absolutely right. There are two problems here. One is there are tariffs and there are tariffs. Not all tariffs are created equal. And think about it. 3 months ago, did you think, I didn't certainly, that one of the first targets of the administration would be Canada? The fact of the matter is Detroit and Ontario, for 80 years, since 1945, have been tied at the hip. A car part goes back and forth 6 times, ends up in a US-made car, which is why no one thought that Mexico and Canada would end up being targeted. And that impact economically will be more significant. But the absolute numbers also, you're very, very right. If the president says there are sectoral tariffs on autos, for example, 25%, that adds to the tariffs that are reciprocal. So if tomorrow, for example, we say 15% tariffs on Europe, that means there are 40% tariffs on European cars.
Right.
That's enough to send that region into a recession also. This is a big, big deal.
Ajay, you just described the theoretical car park crossing the US-Canadian border up to 6 times. I mean, President Trump said policing this is going to be easy. I mean, that's one question. But secondly, how can it not be inflationary?
It is not going to be easy. I mean, the administration as much as acknowledged it. So if you remember, when we put on the auto tariffs, we put $275 billion of direct finished auto imports. That gets a straight 25% tariff. And then there's $270 billion of auto parts. But of that, half come from Canada and Mexico. And on those, there is a stay, because they need to figure out how much is US content, US value added. And I think that stay might continue indefinitely. It is not going to be easy. Now, as far as your second question goes, on the inflation side, prices rise. There's just no way around it. You don't suspend the laws of economics. Now, perhaps, if I were being charitable on this front, it's a one-time price rise. So it doesn't mean that it continues into 2026, 27, and so on. So in that sense, it's a one-time rise in the price level. But this year, inflation is going to rise if tariffs rise. There's no question around it. We are putting in about 3.5, 3.6% on core CPI by the end of 2026-25, much higher than we thought 3 months ago.
So a one-time price rise, and how about the hit to growth? And I'm really asking here about stagflation risk. What's your view on that?
So there are 2 supply shocks hitting the U.S. economy simultaneously. Supply shocks are stagflationary. They push down growth, they push up unemployment, and they push up inflation. The first one, let's not forget, is the immigration supply shock. Suddenly, there is a big collapse in labor supply in the United States, which is stagflationary by itself. And then, separately, you also have the tariff supply shock. I'm not prepared to go so far as to say we are in stagflation. But this year, even in our baseline, which like Rebecca said, is not as negative on tariffs as it could be, we still have growth barely positive, and we have inflation about 3%. That is reasonably stagflationary, yes.
I mean, Ajay, let's dig deeper into that and what this means for the US economy. We were not talking about a recession in the way we were even just a month or 2 ago. Yeah. How have you reassessed that? I know it's not your base case, but what are you thinking?
It's not my base case, but push me hard enough and I can be convinced.
Okay.
There's 3 or 4 things that have all happened simultaneously. The first, and I know we keep talking about it ad nauseum, but policy uncertainty is a thing. I mean, take the first week of March, for example, right? On Tuesday of that week, we pushed 25% tariffs on Mexico and Canada. Wednesday, we take autos away. Thursday, we take all USMCA away. Friday, we say there might be reciprocal tariffs coming that day. If you're a business in the United States, you have a supplier, a customer, either in Mexico, Canada, the EU, or China, very, very likely. You just don't know what to do. You're completely frozen for a while. And if enough people do that, then that starts to stall economic activity. And then that brings me to the US consumer. The U.S. consumer has been the bulwark, I would argue, of the global economy, not just the U.S. economy. China runs a current account surplus. The European Union runs a current account surplus. The U.S. runs a massive current account deficit. And it's thanks to the U.S. consumer. But savings rates are very, very low. Now, there's reasons why they are low. There's lots of excess savings. U.S. household wealth has gone up a lot. But you get this steady noise of job cuts in the government sector, tariff uncertainty, actual price rises, equities pulling back. It's not that hard to see the savings rate rise, say, a couple of points. 70% of the economy is consumption. The savings rate goes up a couple of points, consumption goes down a couple of points. And that's a 150 bp hit to growth right there. That's your recession.
And it's, I mean, you're describing that there has to be this sort of series of shocks in order to see that follow through for the U.S. economy. But it is plausible, to your point.
Yes, and I would say some of those shocks have already happened. The soft data, the sentiment surveys for consumers have absolutely cratered. Now, the hard data has still not followed, and maybe it won't, but the magnitude of the decline, how gloomy consumers feel, I would be very, very surprised if consumption doesn't pull back at least quite a bit, if not to the point where you get a recession. So some shocks have happened.
All right, Ajay Rajadhyaksha from Barclays is going to be staying with us, and tariffs also going to be the focus of our conversation later on with Duke Kunshan University Executive Vice Chancellor John Quelch going to be joining us. We'll ask him how Beijing might react to those US duties. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is The China Show. Let's take a look at how China futures are tracking at the moment. Looks like we're heading for a soft open on the mainland. We've got Hong Kong futures in modestly positive territory. You might see at the bottom of your screen there as well. The reference rate for the yuan, that just dropped a few moments ago, coming in 7.1775. Not a lot of change from the previous day, but again, somewhat firmer than was being anticipated. The offshore yuan there, 726.85. Rebecca.
Thanks, Paul. And we're still joined by Ajay Rajadhyaksha, Global Chairman of Research at Barclays, with us here this morning. And we were just talking about tariffs, the roll through and impact that we see in the US, how ugly it could get. I want to ask also about Asia.
Sure.
Where are the biggest pain points? And I guess how ugly does it get in this part of the world?
So I think one pain point would be Greater China, so not just China. But remember the 2018 tariffs, Rebecca. Now, one of the frustrations of the Trump administration is how that impact was diffused away. Yeah. Because China started trade deflection, started routing things through Vietnam, Bangladesh, Mexico, and so on. And the actual tariff hit was very, very little. And they are trying to prevent that. But if they prevent that, then they do start to hurt countries where that trade is being routed to. And most of that is Greater China. India, I think, is a little more isolated. In many ways, it's an economy like the United States. It's more services heavy. It'll get hit, don't get me wrong. Right now, for example, as you know, there's this 6% tax that India tends to impose on ads for digital advertising and that they're trying to get rid of because they're saying, look, we know it hurts US big tech. We are trying to do what we can. So the country seems nervous about US tariffs. But if you ask me to pick one or two areas in this part of the world which will be a little better than others of the big economies, India would be it.
What about the potential offset if we are able to see Asian countries finally not necessarily doing trade deals, but some kind of agreements? I'm thinking, for example, we just had the conversation between Japan, South Korea and China.
Sure.
That's been a deal that's been in the offing for years.
Yes. That helps, but it doesn't help enough. The fact of the matter is that most of these big economies, with the exception of the United States, they all run trade surpluses. Someone has to run the trade deficit on the other side. And that tends to be almost exclusively the United States for the most part. So if that, and the Chinese have ramped up on manufacturing. On the electric vehicle side, for example, right? I don't know who takes up the slack if the US is saying no mas, our borders are closed. So I think these trade deals are useful. Maybe they're indicative of other countries saying, look, we'll band together to come up with reciprocal tariffs on the US if we are hurt badly. But what is the direction we are going in this global trade war? There's just no positives here from an economic standpoint that I can find.
Yeah, Ajay, if there's no one around to take up the slack from the excess capacity, what does it mean for China? I mean, we've seen China recapitalize its banks. It's getting ready to withstand a trade war. But how well is the Chinese economy, the Chinese consumer, bedding in for the long haul here?
So China, Paul, seems to be an economy in two halves. The technology side is really doing very, very well. I'm not talking just about the DeepSeek breakthrough or the 7nm breakthrough or the BYD 5-minute charging. I'm also talking about the speed with which machine learning seems to be propagating through individual parts of the economy. Hangzhou, for example, right, is you have these 6 dragons. There's very many impressive things going on. The problem is the real economy on the other side. This is still an economy that is struggling with deflation. Headline inflation is still 0 to 5.5% for the last 2.5 to 3 years. The household sector, like you said, just got a $20 trillion asset price shock, largely because of housing, not because of equities. And it seems to be slowly slipping into this, I don't want to call it a spiral, but things are not improving enough on the real economy side. If I looked at HSCI Tech, right, and then I looked at the real economy, I wouldn't necessarily guess that they are part of the same country. And I think they are going to have to do more stimulus. Now, so far, their approach has been reactive, not proactive. We do not expect that to change. So as a result, we've been below consensus on China growth for the last 2 years. We are still below consensus for 2025. Things won't fall off a cliff, but our economic activity indicators suggest this is not an economy that will grow at the 5% target.
All right, Ajay Rajadhyaksha, Global Chairman of Research at Barclays, thank you so much for joining us. We do have plenty more ahead. This is Bloomberg.
Good morning.
Okay, we're just a few minutes away
from the show. Oh, sorry,
yes,
Paul.
Waiting on that open in Hong Kong. Yeah, well, it's looking like a positive start to the day in Hong Kong. We got trading underway in about 3.5 minutes, 4.5 minutes, 3.5. Anyway, better by 0.4%. Looks like it's going to be a positive day for tech as well. But of course, casting a long shadow over everything, Liberation Day in the US. We just heard from the Treasury Secretary Scott Bessent a little bit earlier on. Those tariffs are going to be announced 3 p.m. Eastern Time on Wednesday in the Rose Garden, no less. So we might expect a little bit of pomp and ceremony, Rebecca.
And a couple of stocks that we are eyeing here as well in focus for today. China property. We did, of course, have results from Vanke coming in. Vanke reporting its first annual loss since 1991. We're very focused there in terms of what we see for potential restructuring support that comes through on the government side, as well as, of course, an eye on property earnings, which are coming through, many of which this week. Stay with us. You're watching The China Show. Good morning and welcome back. You're watching The China Show. We're counting down to the open of markets. It does look like perhaps we are starting to see a little bit of positive momentum returning in the Hang Seng up in the early goings, of course, about 0.4%. We did have quite a steep loss yesterday, 1.3%, the worst day in about a week for that index, Paul.
Yeah, it's still uncertainty reigns. I mean, nobody could really predict what's going to happen, right, Rebecca? We've got some pretty positive gains today, but as we count down to Liberation Day in the US, 3 p.m. Eastern Wednesday on the White House Rose Garden, look, we've got President Trump saying he's going to be very nice. What does that even mean? We just don't know. So some modest gains at the moment, but all we can say for sure is it's not going to be a dull week, is it? Avril Hong standing by with a look at markets. Avril.
Yeah, not dial at all. I mean, look at how the mainland stocks are shaping up. We're seeing some gains, interestingly enough. That tariff overhang to kind of cut through some of the noise. I think Bloomberg Economics actually had a really good note about what severe would constitute, what lenient would constitute. So maybe worth raking through some of that as well. But in the meantime, it's looking pretty flat. Take a look at how we are shaping out for Hong Kong, because we did get that note from Morgan Stanley saying to add offshore Chinese stocks. Maybe that these external, outside of China economies might fare a little bit better amid the reciprocal tariff overhang. And then we are, of course, trying to rake through some of the clues for China's economic recovery. And in terms of that, we did get that factory activity on the official front just a day ago looking quite positive. We're ticking down to some private survey data, the Tyson manufacturing later in the hour. But flip the board, because we also get a sense of that from the property sector as new home sales fell. And then keep in mind as well that for China Vanke, this property developer that's been trying to engage in an overhaul, reported its first annual loss since it IPO'd in 1991. And this is what we're seeing in the stock. Flip the board again. We have another EV maker in focus, XPeng, and it managed to kind of exceed or meet at least its delivery targets for this quarter, just based on what we're getting from the month of March. I think 93,000 thereabouts is the target for this quarter. But don't forget, many of these Chinese EV makers are seeing their market share in Europe especially under pressure. Rebecca.
Thanks, Avril. We also heard from President Trump earlier about the impact of tariffs. Paul alluded to it a little bit earlier in the show. Let's just take a listen.
Are you concerned that this move, the tariffs this week, could push some of the United States' closest allies to work with China?
No, I'm not worried about it. I'm not worried about it, yeah.
Mr. President, can I ask you
I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs because, they've been unfairly tariffing the United States for years.
Let's get some insights now from our next guest. John Quelch is Executive Vice Chancellor of Duke Kunshan University. I mean, you, like all of us, have kind of been glued on the tariff story. We're now sort of getting a somewhat whiplash in messaging. How do you think Beijing is viewing all of this?
I think Beijing has a lot of experience from Trump 1.0. Beijing is always very deliberate and proportionate in its response. I think this time round you're going to see a similar relatively calming and non-emotional reaction, but I do believe this time round that China has probably done more to have pre-discussions with other Asian countries regarding coordinated response to what may be tariffs that are imposed on multiple countries simultaneously. Up to now, China has not really been the focal point, at least in the media. We've been hearing about Canada, Mexico, but already China has had to bear 2 10% tariff increases, and many Chinese manufacturers are no longer able to pass on or are no longer able to absorb these kind of increases in cost in their own manufacturing operations. They've reached the limits in many cases of the efficiencies that they can extract in their own business operations, and therefore any extra tariffs that are imposed are really going to be very difficult to share or absorb, and that means that the full extent of the tariff would be passed through to U.S. distributors and consumers.
To your point there that China hasn't necessarily been the focal point, and that has surprised some. We were just talking with Barclays, head of research there, surprisingly seeing that, of course, Canada was hit first, Mexico. Where are the countries that you are seeing the most vulnerability or the most pain? And I suppose, is there a secondary or tertiary effect of that through back to China?
Certainly. So the so-called Dirty 15, which I think might be renamed the Dirty Dozen. These are the countries that have the highest trade surpluses with the U.S., of course include many Asian countries, Japan, South Korea, Taiwan, Vietnam, as well as Canada, Mexico, and China being the big three, along with the European Union. So I think that it was interesting that Canada and Mexico were included early on, which in a sense shows that President Trump not targeting China specifically, but rather as he has said, going across the board to try and extract reciprocity and, as he sees it, fairness from these trade arrangements.
Of course, John, running a trade surplus with the US doesn't necessarily, well, help you. Look, let's take the case of Australia, for example, in which the role is reversed. Australia is one of the rare countries where it imports more from the US than the US buys from Australia. That hasn't saved the country. Do you think there could be other surprising countries included on that list when we get it on Wednesday?
Well, the countries that running surpluses include the Netherlands, the UK, Australia, United Arab Emirates, a few others that I may have left out. These countries are likely to be the countries that are treated nicely, to use President Trump's expression, which you quoted earlier. I think that when you look at the number of tariffs that actually have to be reviewed for this reciprocity analysis, by one estimate, there are 2.5 million individual product country tariffs that are under review if this review is comprehensive. Very hard to believe that that level of review can be conducted efficiently in the 30-day or 60-day period. And accordingly, it strikes me that we are going to see a little bit of a sledgehammer approach as opposed to a precision targeting approach. But the sledgehammer approach may create shock and awe in the media, but there may be exemption opportunities that are in the fine print associated with the public pronouncements. So I think we're going to have to wait and see what the fine print is, and each country is going to have to analyze its own situation before being able to intelligently respond.
What do you feel the impact's going to be here for US consumers? Because how much of the cost of tariffs can US businesses that rely on imports realistically eat without passing them on?
Yes, as I said previously, I think the companies that import a lot from China, such as Walmart, have been quite keen on sharing the burden with their suppliers through the distribution chain to minimize the impact on consumer prices in the U.S. But we may have reached the end of the road in that regard if there are additional tariffs on China manufacturers. And that means, of course, higher inflation, but it also means that consumers have the option of deferring purchases or switching to purchases that may be a little bit more expensive from other countries as substitutes. All of this cannot be healthy for economic growth, as many commentators have indicated previously on your show.
It's not just a question, though, of Chinese manufacturers struggling, John, to take on the cost, that extra cost of tariffs, and then therefore having to pass it on. There's also this issue that in this period of uncertainty, companies just simply aren't able to make decisions. And we are seeing some higher rates of corporate failures, especially among smaller, medium-sized enterprises struggling on how to sort of forward plan. What kind of mood are you reading on the ground in China? To what extent is there sort of anxiety over the ability to sort of just tread water while we wait for that really critical concrete detail that you're mentioning?
The margins in many of these enterprises are already at razor-thin levels. And remember that these are largely manufacturing enterprises. They do not have brand marketing power, so they're really subject to the vagaries of pricing in the market. I think that it's very difficult for local governments, except in some of the more prosperous areas, to buttress their manufacturing capabilities. And so, you know, there isn't much that can be done other than to pivot, maybe withdraw a little bit from the market and cut down the size of the operation, and then wait for an opportunity to rebuild. It's going to be very tough for some of these small and medium-sized enterprises in China, as it is, by the way, in the United States, where many small businesses have been built on the back of reliable China supply chain. And if that supply chain is now going to be even more expensive than it has been in terms of the delivered goods, that's going to be a big blow to many small and medium enterprises in the U.S.
I mean, to your point, you're also sort of at the coalface of people-to-people exchanges in your role at Duke Kunshan. You have historically been quite optimistic about seeing some of that return through. I wonder if you're seeing any impact, though, when it comes to some of the policies and these sort of anecdotal stories about immigration difficulties at the U.S. border that people, even with legal visas, are facing. Are you seeing that translate into anxiety and hesitancy on the China side to continue to travel to the U.S. and exchange and kind of go for jobs, work, visits, and so on?
So in our own broader academic community, I don't feel that we have seen much, if any, evidence of that. But where I think there is an issue is many Chinese students, of course, go to the United States for higher education with a view to having an opportunity upon graduation to work in the United States for a year or, in some cases, up to 3 years, depending upon what subjects they're studying. If it's STEM, they get to stay a little bit longer. Now, what we're seeing and hearing anecdotally is that it's much harder for Chinese students graduating, however brilliant they are, to secure employment in the U.S., and that's because the companies potentially hiring them aren't feeling certain that if they prove themselves, they'll be able to keep those employees for the long term. So the uncertainty around visas, even though there has not been any particular new measure associated with visa availability, but the uncertainty around visas is giving some, I think, pause as to whether or not they should go to the U.S. to take graduate study, or whether or not they should divert to Australia or the UK or Canada as alternatives. So that's where I think we are in terms of China inbound student interest in the U.S.
All right, John Quelch of Duke Kunshan University, thank you so much for joining us with your insights today. Okay, if April 2nd was going to be a big day, April 4 is going to be a big day too. We've just heard that South Korea is going to be ruling on President Yoon's impeachment on the 4th of April. This is according to a report from Yonhap. So that ruling due 11 a.m. April 4. So that will be a big day for markets in Korea and perhaps elsewhere as well. Plenty more to come. This is Bloomberg.
Good morning and welcome back. You're watching the China Show. We do have some numbers now coming through. That's the Tyson PMI that we've been watching for this morning for the month of March. So March Tyson manufacturing came in at 51.2, higher than the estimate, which was at 50.6. And just noting that we did, of course, also have factory activity coming in yesterday. We saw a beat there. China factory activity expanded at the fastest pace in about a year in March, Paul.
All right, let us take you live now, where we are going to have SpaceX about to blast off Crew Dragon there on the launch pad at Kennedy Space Center in Florida, all set to depart for, well, it's going to be a first, Rebecca. This is the 6th crewed commercial mission that SpaceX has done. They've done 11 to the International Space Station for NASA, but this is a crewed commercial mission, and it will be the first to fly over Earth's polar region. So this is called the FRAM-2 mission. There's 4 astronauts on board, all on their first space flights. Leading that is Choong Wang. He's a 42-year-old entrepreneur and adventurer. So he's chartered this mission with SpaceX aboard the Dragon Resilience spacecraft. Let's listen to this countdown.
5, 4, 3, 2, 1, ignition, and liftoff. Copy, 1 Alpha. Vehicles pitching downrange. Stage 1 propulsion is nominal.
T plus 35 seconds into the FRAM-2 mission, the first ever human spaceflight mission to cover the poles.
And we are throttling down the engines on the
SpaceX also, of course, played a role, Paul, when it came to those NASA astronauts that were stuck on and spent about 9 months on the International Space Station.
Max Q, and there's Max Q.
Yeah, that's right. And we heard from Butch Wilmore recently, giving his first interview after returning. He says he backs the Boeing Starliner capsule, and he says the company is also completely committed to fixing the issues on that. He says they're going to make it work. Boeing's committed, and NASA's committed as well. But that whole episode really just underscores how difficult space flight is. We watch these liftoffs now from SpaceX's Falcon 9 with just... well, they're like a bus schedule now, aren't they? They're so regular, we take them for granted. But we have to remember, when SpaceX was first testing the Falcon 9 system, it exploded all the time. There were multiple failures, but now just look at how reliable it is. The booster that's flying today, Booster 1085, that is its 6th flight into space, and the Dragon capsule on top carrying those 4 crew members. This is the 4th flight for this capsule, Rebecca.
Yeah, thanks, Paul. Anyway, we'll keep an eye on how that all proceeds over the next couple of hours as well. Shifting gears a little bit, bringing it back to something a little bit more terrestrial, President Trump's latest comments suggest a deal for the social media platform TikTok may be tied to tariffs on China. We're joined by Bloomberg Intelligence equity and strategy analyst Marvin Chen, who says that Chinese markets are poised to benefit if Beijing does indeed reduce or avoid U.S. tariffs thanks to a TikTok deal. Marvin joins us now. Let's kick off first on the reaction question. Even just this week, we've seen a sort of whiplash reaction. How are we expecting Chinese markets to react post April 2nd when we get a bit of clarity on reciprocal tariffs?
Yeah, I think Chinese markets are a bit more defensive to the upcoming tariffs. Some of the fundamental reasons we've discussed before. Low U.S. revenue exposure, and China is also one of the least dependent export economies in the region. With exports accounting for roughly 20% of GDP. But the other thing is that China does have this TikTok deal. The deadline is set for also the end of this week, and this is something that Trump has highlighted that he wants to get done and could potentially reduce tariffs to get done. So China does have some leverage from this perspective.
To what extent will, let's say maybe not April 2nd, but April 4th or 5th, to what extent is that going to be the end of tariff volatility for now?
Well, I think, we do see a potential for markets to kind of rebound once the news is out, given, just how much we sold off over the past several days. But a lot of this will depend on kind of the announcement and the details, whether there will be some way for markets to or countries to roll back these tariffs going forward. But in terms of tariff volatility, we do expect that to stay. The Trump administration has made it clear that tariffs tariffs are a part of their foreign policy going forward.
So how's your outlook for Chinese stocks then? Any other catalysts here?
Yeah, I think, given the external environment and, just the Chinese market valuations, they're kind of back at average. We think the valuation rally is pretty much complete, and going forward, the focus will really return to the improvement in the domestic economy and an improvement in fundamentals. Market attention may turn back to policy support. We expect, the fiscal support that was announced at the MPC earlier in March to be front-loaded in the coming months. But in terms of monetary policy, I think we're going to have to wait until later in the year, for the Fed to act first before China can ease there.
All right, Bloomberg Intelligence Equity and Strategy Analyst Marvin Chen there. Let's take you back to the images that we're getting from SpaceX. You can see now that we've had stage separation, the capsule now under its own power with the 4 astronauts on board. Just a word on those 4. I did mention Choong. He's the 42-year-old entrepreneur and adventurer from Malta. He's bankrolling this. Jannica Mikkelsen, 38-year-old cinematographer and director. She is the commander of this mission from Norway. We have Rabia Roja, 29-year-old robotics researcher from Germany, and also in Australia on board. Eric Phillips, 62-year-old polar explorer, will pilot this mission, but it is the first flight for all of this crew. And what's special about it is it's going to be the first flight over Earth's polar regions. So the crew will be studying atmospheric emissions, which resemble auroras. They'll also be taking the first human X-ray in space, and as well as doing a number of other experiments around blood flow restriction devices, the benefits of strenuous exercise in orbit, space motion sickness, also growing mushrooms for nutrition and long-term food sustainability. So you can see where all this is going. This mission also part of the preparation for much longer duration missions, potentially to the moon, and of course Elon Musk's ultimate goal, which is to send a crewed mission to Mars. That's pretty much what the Starship tests are all about as well. The super heavy booster, the one that gets caught by the mechanical chopstick arms. The intention is one day that propels astronauts to Mars, when a lot of the research done on these missions could potentially be put into practice. On the left of your screen there, you do of course see the booster B-1085 on its 6th flight that is now returning to the launch pad. And as I mentioned a little bit earlier, Rebecca, we now just take these sorts of images for granted. Seeing that thing land, however, remains a ballet of technology that never gets boring.
Yeah, that's right, Paul. Just a quick reminder, actually. In fact, I was having a debate with Kathy Wood and Bob Smith last week at HSBC about SpaceX and the future and just who it is that's going to dominate. A quick look on your screen also at some of the analyst actions that we are watching today, all focused on banks there. Bocom raising to neutral at JP Morgan, for example. All JP Morgan moves, in fact, on your screen there. Bank of China also raised to overweight by JP Morgan. Stay with us. You're watching The China Show. A very good morning to you. Good morning and welcome back to The China Show. Here's a quick peek at the HSI. About half an hour into the session, and we're about higher 0.7% or so. Perhaps some recovery after quite the sort of steep sell-off that we saw going through into yesterday's afternoon session for the Hang Seng. For a close look at markets today, Avril Hong is with us. Avril, what are we seeing?
Yeah, interesting. A bit of a Tuesday turnaround, Rebecca. We're seeing that bounce also in Australia after earlier slipping to the lowest level in 6 weeks or 7 weeks on the benchmark in the country. Today, of course, we have an RBA decision. It's not expected to cut, but maybe the path is towards May. And amid all this, the key question is how much does tariffs and the inflation impact potentially constrain the path for other central banks, not just the Fed, maybe on Australia bonds there. we're hoping for a pivot from the RBA, holding fairly steady there. But by the time the dust settles, maybe the pain point is going to be on the Aussie versus its G10 peers, considering the paths of the ECB as well as the BOJ. Flip the board, because we're not just keeping an eye on the Aussie dollar, it's also about the Korean won firming up today. We do have a date for the results or the ruling on President Yoon's impeachment. Ahead of that, we also got some of the data out of Korea where exports firmed up ahead of tariffs. So maybe influencing the picture that we see on the Korean won. Flip the board again. If you look at stocks, we're seeing it across the board as well, more or less that bump up today. The Kospi outperforming 1.6%. But don't forget, for many of these Asia indices, not so long ago, they were hovering near correction territory, including on the TAIEX. That turnaround, as I say, for today, that key overhang still about levies from the US, Rebecca.
Thank you so much. Let's dig a little bit more into markets now. We'll bring in Stephanie Leung, CIO at digital wealth platform StashAway. Stephanie, good morning. Thanks for joining us.
Thank you for having me.
Let's start on the US story. We are Liberation Day coming up tomorrow, perhaps sort of Liberation Week. It feels like this is every day. Is this the end of the US exceptionalism narrative?
Yeah, obviously there's a lot of kind of focus on what Donald Trump is going to say on Wednesday. And I think probably the most used word recently has been uncertainty. And if you kind of look at the U.S. policy uncertainty index, indeed, it is back at heights that are close to like 2008. So there is indeed a lot of uncertainty in the U.S. policy. And I think if you look at the reciprocal tariff, what Donald Trump has said is that, U.S. has been kind of on the negative side in terms of the fairness about all these trades and tariffs, etc. And he's going to raise it to levels that are imposed by other countries. Now, of course, if you look at just the tariffs themselves, it's not that much. However, there's a lot of leeway in terms of how you interpret the non-tariff taxes. For example, VAT in European Union, that's something that Donald Trump has talked about. And if he actually goes after those, there's a lot of room as to, how much he can raise the tariffs. So we'll find out on Wednesday, I guess. At the same time, markets are tanking, and a lot of people have asked about, so is there a Trump put? Is there a Fed put? Where is that on the S&P? And I think from what we've observed so far, S&P has corrected 10%. Trump has clearly said that, he's not watching the stock market. The next one, perhaps, the next question to ask is perhaps, where's the Fed put? Where is Powell going to be cutting interest rate aggressively in response to a falling stock market? And I think if you look at from that perspective, perhaps, if you look at 2018, that was a good kind of historical example. The stock market actually fell 20% before they did the pivot. So I think this time around, if you look at Trump, his put is probably not at the S&P. Right. The right put is actually perhaps on U.S. Treasuries, because that's what they're targeting to get down. That they're targeting actually to get interest rates down. So I think it creates a trickier dynamic for the stock market in the U.S. And that's why when we published our last CIO Insight piece, we actually titled it "No Pain, No Gain." So the next few months perhaps could be still quite choppy.
With that in mind, are you shifting, any of your allocation, or you shifting how are you sort of positioning your portfolio, and have you changed your outlook for cuts through this year, Fed cuts?
Yeah, I think for us, because we actually allocate globally diversified asset allocation portfolios, so we have a kind of a more neutral, slightly overweight stance on the U.S. equity markets. But overall, for all our portfolios, we've actually been overweighting in gold compared to the traditional 60-40 portfolio. Now, obviously, gold has done very, very well. And year to date is actually up north of 10%, and now it's breaking all-time highs as well. So when we actually, when we did the allocation to gold earlier last year, it was based on the premise that, number one, inflation is still a big problem that is perhaps not going away in the short term. And then number two is actually a very, very good kind of hedging instrument versus risky assets like equity. Because if you think about the traditional 60-40 portfolio, that 60% is risky assets in equities, and that 40% is mostly in bonds. In our view, in a kind of sustained high inflation environment, bond may not be as protective as before, and that's why we added gold to our portfolios. And so far, I mean, gold has been protecting our portfolios fairly well.
Yes, you've been well rewarded with that investment, but of course a lot of people don't like gold because it doesn't pay you anything. So do you look at gold miners as well, who could be heading for maybe a year or two of pretty decent earnings?
Yeah, I mean, obviously, gold miners are very leveraged plays on gold. We feel that, in a portfolio that has kind of a more risky tilt, that could be useful for kind of a protective asset. Still, you want to own physical gold because at the end of the day, that's sort of like the only asset that provides you safety in terms of pure kind of exposure to the asset class. Of course, in a levered kind of riskier environment, the gold miners would be a very, very good kind of allocation within your equity allocations as well. I think in terms of gold, there is also the narrative of an alternative to the U.S. dollar. Now, obviously, U.S. dollar has been very, very strong in the Fed hiking cycle, and it seems like a strong dollar may not be what the administration is now pursuing. So in the absence of a kind of alternative in terms of currency allocation, in terms of cash allocation, gold again plays a very important role.
Do you see an environment coming of perhaps broad dollar weakness? And if that's the case, which economies, which markets do you think might be best positioned to benefit from that?
Yeah, if we actually enter a sustained kind of weaker U.S. dollar environment, I think the most obvious kind of economic bloc to benefit would be emerging markets. And particularly, I think, if you think about, China, for example, we've seen some of the data stabilizing in terms of property transactions, in terms of, the macro kind of economic data. PMI just came out yesterday. It was above expectations, back in kind of expansionary territory. Although the recovery is not a V-shaped recovery, we do see kind of a backstop to the stagflation or kind of to the inflationary environment that China has gone through in the past 2 to 3 years. So perhaps, combined with low valuations, a weaker U.S. dollar, that could be a decent environment for China.
Do you see the sort of deep-seek tech optimism-driven rally? Do you see that carrying legs in terms of momentum if we don't see a more decisive improvement in the real economy? As you say, we're seeing these green shoots, but nothing overwhelming.
Yes, I think that's a very, very valid point. And in the sense that if you actually look at the Chinese equity market, a significant proportion of that is actually in tech. It's not really the old industrials. So names like Tencent, Baba, or like Pinduoduo, all these kind of tech-driven companies, they have a lot of application for AI. And I guess if you think about the last 2.5 years, the whole AI story has been focused in the US. It's been about the Max 7 NVIDIA. And I think there is, in the past few months, there has been a shift in investor sentiment, towards looking beyond these stocks. And obviously, positioning is still quite crowded. Yeah. So, in the past 2.5 years, there was actually no alternative. Today, you have some alternatives. You have the China tech story. You have a European fiscal story. So I think there will continue to be rotation out of the Max 7 into these different stories in the next few months. And also, I guess more importantly, because valuation is still quite extended for these Max 7 companies. So it'll take some time for that valuation to normalize. So I think next few months we're going to see a bit more rotation into these new stories.
So for that rotation, when it comes to China tech and China consumer writ large, is this a tactical moment or is this a structural moment for investors?
Yeah, I think, it depends on what story you're talking about. I think if you're talking about the China tech story, I think it is a structural story, right? If you talk about kind of China old cyclicals, it's probably a tactical story because it's low valuation, investors are not positioned in it. But ultimately, when you invest in China, you want to find growth. So where are the growth areas? These are focused in the tech sector. These are focused on perhaps, some of these IP names as well in China. I think China consumer names, if they have a good brand, there is a big market for them. And particularly if the trade war actually starts, right? If these reciprocal tariffs actually continue to escalate, I mean, China and a lot of other economies are going to be a lot more inward-looking in the sense that they will need to develop their own technology stack. They will need to develop their own consumer kind of end markets. And that is kind of perhaps, I mean, a story that can kind of play out in the next few years.
All right, Stephanie Leung, CIO at StashAway, thank you so much for joining us. Still to come, President Trump says he could see the US giving China tariff relief if a deal is reached on the sale of TikTok's US operations.
Good morning, you're watching The China Show. Now, the US is sanctioning more senior Chinese and Hong Kong officials in Washington's latest steps to target authorities over Beijing's national security crackdown. Let's get more details on who's being targeted and the city's response with Bloomberg China economy and government editor Alan Wong. Alan, tell us, first of all, who's been sanctioned, who's been hit, but also the significance, because for figures that don't have these kind of deep connections to the US, arguably there's not that much tangible impact.
Well, the latest sanctions target 6 Chinese and Hong Kong officials, including Hong Kong Secretary for Justice and also its police commissioner. So as you said, yeah, they're not very much exposed to the U.S. because their predecessors have been sanctioned before, so they know how it goes. If they had any U.S. access or exposure, I think at this time they would have limited that for now.
So we've got Beijing also putting pressure on CK Hutchison over its pending Panama Ports deal. What's happening there?
Yeah, China is putting pressure on Li Ka-shing, CK Hutchison in a number of ways, both official and kind of official. Officially, they've said that their anti-monopoly regulator will review the deal for any violations, and they've also ordered state companies not to work with Li Ka-shing's company and start new dealings from this point on. And in some more unofficial sounding ways, China's top office overseeing Hong Kong affairs have been reposting critical articles on its official website in the last week. So they've been posting every day Tai Kung Pao articles on the website criticizing the deal and asking Li Ka-shing and other companies involved to walk away from it.
Alan, it's also been interesting to see this all happening at a moment when President Xi is making this bid to foreign companies, in a way to be champions of free trade, including many US companies. But we also, of course, now have this very obvious example of CK Hutchison being caught in the crosswinds. What does this mean for businesses and multinationals trying to operate in that Chinese context, in this geopolitical context more broadly?
I think this reveals what priorities Beijing has in the face of national security risk that it perceives and its desire to attract more foreign investment. So it was just Friday when Xi Jinping sat down with some 40 global executives and tell them that China's door is open to them and that China would love more of their investment. And Xi Jinping even contrasted China subtly with the United States, saying that China's policy environment is stable and predictable. But obviously on the same day that we heard from the State Administration for Market Regulations announcing that they will review the CK Hutchison deal if it goes through. So that sends a message that I think one expert told us amounts to white-knuckling a private company into submitting to China's national priorities.
Yeah.
All right, Bloomberg China economy and government editor Alan Wong there. Here are some of the global stories that we're following. French far-right leader Marine Le Pen has been banned from running for elected office, risking a surge in anti-establishment sentiment that could undermine efforts to stabilize the nation's finances. Le Pen plans to appeal her conviction for embezzlement, calling the court ruling a political decision.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because, in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear, I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Japan's parliament has passed an initial budget after multiple revisions. Lawmakers approved the spending plan amounting to 115 trillion yen, that's just over $770 billion, just a day before the start of the new fiscal year. Prime Minister Shigeru Ishiba has been forced to negotiate with smaller opposition parties to pass the budget, at times conceding ground to their requests. Plenty more ahead. This is Bloomberg. Let's take a look at how Nintendo shares are tracking, broadly following the sentiment in Japan at the moment, better by about 2.7%. And of course, it's going to be a big day for Nintendo, or a big week anyway, with pre-orders for the Switch 2 console starting this Thursday. Well, Bloomberg Opinion columnist Garode Reddy says the stakes have never been higher for Nintendo. Garode is in Tokyo, joins us now for more on his column about the Switch 2. And Garode, full disclosure, I love video games. I own a Switch and I am not feeling the urge to upgrade. Are people like me part of the problem?
Well, this is the thing. I mean, obviously we don't know, we're going to have this information that's going to come out tomorrow that has all the crucial things that we know whether you're going to want to upgrade or not, right? All we've seen so far is basically little more than a render. You have it up there on the screen now of what it's going to look like. We still don't know how much it's going to cost, when it's going to launch, and crucially, I think what kind of games are going to be on it. But, what I was saying in my piece was that, yeah, there's a lot of need for Nintendo to get this right. The Switch, such a driver of its sales and its revenue and its profits over the past 8 years, really surpassed all expectations when it came out. Can they repeat the trick again? Going into this, this reveal that they have coming up tomorrow that you have up on the screen there at the moment, that's going to be the real trick to persuade users such as yourself if they're going to upgrade or not.
So, great. If people like Paul don't go out and buy this, just follow us through, map out the picture. What goes wrong for the company, and what's really at stake here?
So you can go back about a decade to the launch of the Wii U to see what can happen when things go wrong. The Wii, if you cast your mind back to the mid-2000s, the Wii was an incredible success. One of Nintendo's best-selling devices ever, but it kind of ran out of steam towards the end of its life. Nintendo came out with the Wii U, but it was a very confusing device and it did not really persuade users to upgrade. A lot of users were kind of confused as to what it was. It was poorly marketed as well, which I think is one reason that you see this clear branding on the Switch 2 this time. What happened then was Nintendo had 3 consecutive years of losses. There was a lot of doubt about its ability to survive in the format that that we all know and associate Nintendo with. There was a big drive amongst investors to try to persuade Nintendo to give up on making home consoles, to switch entirely to mobile. That was the theme that was going around at the time. If they were to have another flop, shall we say, on the level of the Wii U, it would be very, very bad for investors and bad, I think, for gamers. And one reason that the stakes are higher this time is because even with the Wii U, Nintendo at the time had a separate line of handheld devices, the 3DS at the time, that was able to provide a little bit of support. Right now, all of Nintendo's revenue, essentially all of Nintendo's revenue, comes directly from the Switch. That's now fading off. It will need to be replaced by the Switch 2, and that's why they need to make it a success.
Garode, you outlined the importance of the Switch to Nintendo, but it's sort of led to this boom-bust cycle for the company. Is there any longer-term plan to break that?
Nintendo is definitely very aware of the issue. They have had a difficulty over many years in every time they come out with a new machine. Unlike, let's say, your iPhone, when you upgrade to an iPhone, so long as you don't switch to Android, you're still kind of locked into the ecosystem. They can persuade you to upgrade. They bring out a new iPhone every year, but most people don't upgrade every year these days. But with Nintendo, when they went from the Super NES to the Nintendo 64, they don't take all of those users along with them. The user base resets to zero Nintendo, they have to market the device again. They have to persuade people to buy back in. Now, Nintendo is very aware of this issue. They want to get out of it from everything that they've been saying to investors over the past couple of years. One of the crucial things to doing that is going to be tying them into this Nintendo Switch account that they've been trying to persuade users to sign up to, which keeps them in their own ecosystem. They just launched their own app on iPhone and Android last week, where they're kind of distributing news, and that also is tied into the account. They have a music streaming app now that they have that also ties people into the account. And then what they'll be able to do with Switch 2, or at least what we suspect that they want to do with Switch 2, is just to use that account to move people over to the new device. Move all your games, your save data, all that kind of stuff over to the new device, and hopefully smooth out that boom bust cycle that you referred to by gradually migrating users over to the new device.
That's Bloomberg Opinion columnist Garode Reedy there. And you can read that full piece, well worth a read, on the terminal or on Bloomberg.com. Now, a quick check on markets with Avril Hong.
Yeah, Rebecca, there are a couple of stocks that we have in focus today in the Asia Pacific, including those of Hanwha Corp. Of course, this is a group that businesses, kind of span aerospace, defense, energy, and today it at one point surged as much as 70% by the most since the middle of February. And of course, this was amid the backdrop of how some of the succession fears were allayed, given how the chairman is going to give part of his stake in the company to 3 of his sons. Flip the board again, take a look at Xiaomi. Of course, it's been seeing that pressure for the past week or so. Today, we're getting news of that slight upgrade to triple B for S&P and the outlook being kept stable. Still under pressure today, the stock of Xiaomi. Plenty more ahead. This is Bloomberg.
All right, 11:29 a.m. Tokyo time. We've got Japanese markets going on a break very shortly. It's been a mostly positive session, though, for Japanese equities. We've got the Nikkei better by about 0.5%. The Topic's doing a little bit better as well, to the tune of about 2/3%. The yen still relatively weak. It is below that 150 level, though, 149.74 at the moment. We did get the Tankan survey out a little bit earlier, of course, for the first quarter. That index of sentiment edging lower, a reading of 12 in March, so it reflects a degree of resilience, but the outlook for large manufacturers weakened less than expected, down to 12 from 13, and the index for small manufacturers pushing a little bit higher to 2. So never mind the backdrop of tariffs, the looming shadow of April the 2nd, Liberation Day in the United States. Sentiment in Japan seems to be reasonably good at the moment, but as we've seen, Rebecca, what a difference 24 hours can make.
Right, Paul, yeah, thanks. Some of the other corporate stories that we're also following this morning. Huawei has posted its first quarterly net loss in years after US sanctions forced it to spend aggressively on R&D. The Chinese tech giant says its net loss in the December quarter stood at around $41 million. Despite this, Huawei saw gains in its smartphone business, cloud computing arm, and its core telecom unit. The rapid growth in EVs also helped Huawei's smart driving solutions unit turn profitable last year. Bloomberg has learned that US contract chip maker Global Foundries is exploring a potential merger with Taiwan's United Microelectronics Corporation. Sources say Global Foundries' incoming CEO has been considering options as he prepares to take the helm this month. An agreement would require approval from Chinese regulators and may involve heavy borrowing or stock dilution.
Well, Tokyo Gas has reportedly decided to buy part of a shale gas development in Texas from Chevron. The Nikkei reports a deal is estimated at tens of billions of yen and is expected as early as this month. Tokyo Gas will use the natural gas that it extracts from the development to trade on the market as well as supply power plants and other customers. All right, let's take a look at how shares of Chinese biotech firm Akeso, are doing. Year to date, very well, just a shade below 41% so far, and having a good past couple of days as well. We've seen those shares up, getting on for 20% this year. More than that. Well, it was founded nearly a decade ago. It aims to disrupt the pharmaceutical sector with a new treatment option for lung cancer. Recently, though, reported a full-year net loss. Joining us exclusively now is Akeso's founder and CEO, Michelle Xia. Michelle, thank you so much for your time today. So, a loss last year, but how's your outlook looking for the next few quarters?
Thank you for the opportunity to speak with you. First of all, can I highlight our results last year? Hello?
Well, you did show last year. You did show last year that you have a drug, ivonescimab, which beat Merck's Keytruda. This is a dominant cancer drug. It's got close to 30 billion sales. Do you think you're going to be able to replicate those sorts of results?
Oh, okay. Yeah. Okay. So the outlook about the year 2025. So first of all, on the clinical side, we think we will. It will be very exciting for us. First of all, we look forward to getting ivonescimab approved in the first-line non-small cell lung cancer in China. And this is going to be a huge indication in China. 800,000 patients get non-small lung cancer every year in China. So if it approved in China for the first line, that means ivo approved both first-line non-small cell lung cancer in China and also second-line non-small cell lung cancer in China. And in the meantime, our partner Summit in US, they already announced they are expecting top-line results from their first global phase 3 trial, which is also for second-line non-small cell lung cancer for EGFR mutant progressors. So that will be huge. Yeah, so hopefully we will represent both of the results globally.
Yeah, so considering the advances you're making in that respect, I'll put my original question to you again. What's your outlook like for the coming quarters?
So clinically, we will have two phase 3. Well, first of all, approval of the first line. That's what I just mentioned about in China. And secondly, the first global phase 3 non-small cell lung cancer results will be expected. The top line results will be expected to announced. And then that's the ivonescimab. We also have another bispecific antibody targeting PD-1 and the CTLA-4 molecule, cadonilimab. We are also expect results from the cadonilimab, the first approval, first-line cervical cancer in China, which is also the first phase 3 trial of the immuno-oncology molecule for the whole all comers from the first-line cervical cancer. And
Michelle,
then
you just
commercial side. Go ahead, please.
Sorry, go on, Michelle.
Yeah, I mean, from the commercial parts, because we actually already get our two cornerstone drugs, cadonilimab and ivonescimab, into the National Reimbursement List program. Therefore, both molecules, both drugs are covered by China government insurance since the 1st of January this year. So in that point, we also expect a faster growing of the revenue in the coming year.
Michelle, you just mentioned that phase 3 testing. Now, as I understand it, that's for this really potentially pivotal immunotherapy drug that's used to treat non-small cell lung cancer. And it's really made some waves because it could challenge one of the world's sort of best-selling drugs that's existing. Now, this is currently not accessible in the US. You're going through that phase 3 in order to potentially open up sales to the rest of the world. What would it mean if you are approved? And is your plan to expand into the US market with this drug?
Okay, so beginning of year 2023, we licensed out our molecule ivonescimab to Summit Therapeutics, which is an American company. And so they have the rights for US, Europe, and Japan, etc. And so since then, both of us are actually working closely very well so meaning that Summit focus on the clinical studies outside of China, and we focus the clinical studies inside of China. And we both work together to, for example, run the we so-called multi-regional clinical studies, try to make the clinical data accepted both by FDA and both in China and also other regions, regulatory agents. So I don't know if I answered your question. I mean, pharmaceutical drug development is very local regulated industry. And so to be able to get approved in US, we need to run a US trial that accepted by US regulatory agency. And which we are actually doing that. And I think the progress is moving forward very well.
I understand you don't currently have a commercial product in the US, but nonetheless, you are a global company operating in the context and confines of geopolitics. We have had President Trump, for example, talking about tariffs on pharmaceuticals. So how does that context affect your planning and your approach to global expansion?
Well, first of all, we focus on what we are doing, which is a new drug discovery and development. And as a company, the pharmaceutical industry, from my opinion, is always a global industry standard, meaning that healthcare, the drug to treat the patient has no boundary between either Chinese patients or US patients. We do believe that if we make a good drug, it should be used by the patients all around the world. And from that point of view, I don't have a worry. For the ivonescimab example, we actually, again, we have a big collaboration with US company, and they actually got the drug and then try to use the proper clinical studies based on US standard and to make it into the market and to let the US patients be able to use it. I think that's a fantastic thing. And I don't have much worry about that.
Michelle, is this a deep-seek moment for China's biotech pharmaceutical industry?
I was very surprised to be named by deep-seek moment for Chinese pharmaceutical industry. I guess the reason is that biotech industry in China only started about a decade ago, and I think biotech industry is also a long-term, be prepared industry, meaning that you don't have something come out just like 1 day or 1 month or 1 year, not even. One drug takes like 10 years to develop. And so like Akeso, We founded in year 2012. And from that moment, we work very hard for our drug pipeline. And all the way after 10 years, we got one drug approved in China with very good results. And good enough, it can be, in one trial, in one clinical trial, and head-to-head to Pembro, win the game. And we are very happy about that. And I think, again, as I said, so this is a very, in this industry, always is a very collaborative way. We got this drug in China, and we think we got collaborators in US and globally, and that would be benefit for all the human being. I think this is a very good, ecosystem globally for pharmaceutical companies.
Michelle Xia of Akeso there. Thank you so much for joining us this morning. Now, turning to some breaking news just crossing the desk now. US chip grants are potentially going to be in limbo as Commerce Secretary Lutnick is pushing for more investment. So the scoop here, according to sources, is that Howard Lutnick may withhold CHIPS Act grants in order to push companies to expand their US projects. We'll continue to look at that a little bit more closely through the course of the show, of course. There's plenty more ahead. You're watching the China Show. Stay with us. This is Bloomberg.
Geopolitical tensions are driving a lot of interest in New Zealand's revamped Golden Visa program. The country's immigration minister told Bloomberg that the visa is attracting red-hot interest from the wealthy in Europe and the US.
There's certainly been really strong interest from the American market. We had a number of investors who were down here taking a look at New Zealand a couple of months ago, and I spent time with them, and they were really excited. And these are exactly the kind of people that we are trying to attract to New Zealand by saying, hey, we're open to the world. They have incredible skill, incredible connections, a huge amount of enthusiasm to help take New Zealand businesses to the world. I mean, we have some amazing startups here in New Zealand and some great local businesses that investors are really interested in helping out. And so that American market has been very, very interested. And I know many of our immigration lawyers and agents have been up in the US in the last couple of weeks. And their feedback to me was that red hot comment that the American market is red hot and very interested in coming to New Zealand.
How do you get the sense that we're seeing these flows into New Zealand perhaps in the future, given this moment in history right now, more geopolitical tensions around the world? Is it the type of immigrants that are trying to come to New Zealand? Is it the type of visas that they're seeking?
Look, you're right about the instability in the world at the moment. There are a lot of people around the world, especially up in Europe and in America and in Asia as well, who are looking for a country that is politically stable, that has incredible people, an abundance of natural resources, and businesses that are worthy of investing in, but also a place that is really safe and secure. But also I would add, still smack bang in the middle of the Asia-Pacific region, and so very connected to the world, but in a really stable part of the world. And so I think that's part of the attraction. But, it's not only that uncertainty around the world, it's also that migrant investors are looking for opportunities. And we have huge opportunities here in New Zealand. I mean, we are the home of Rocket Lab, for example, the second largest company in the world that launches rockets into space. We have amazingly talented people, a can-do attitude. And I think investors are looking for that as well.
Have you sort of done modelling around the short-term and longer-term economic boost that you could see as a result of this program?
We have, and we've certainly looked to the past of what happened in the past. We have tweaked the visa slightly. We are making sure that the settings are such that they are making sure that investors are really looking to that more high risk, directly investing into businesses and managed funds, more so than bonds and equities. So in the past, we did have a lot of people coming in and investing in more passive investments. The way that we've set up this new visa really is to encourage people to come and invest, as I say, directly into those Kiwi startups, Kiwi businesses, but also into managed funds as well. And of course, that has a greater level of impact. So the modelling we've done around the impact of that it has been really important. But it's interesting that the feedback we've had, again, it's just anecdotal because we haven't looked at the applications we've had in yet today. It's only day one. But the anecdotal feedback has been that investors are more interested in that higher risk category, which is much more beneficial for New Zealand. And that's why we set up the visa in such a way that it is a lot more attractive. So you don't have to spend as much time in country in order to get your permanent residence if you're going in via the higher risk. And it is also a lower amount of money as well. So we are initially seeing that there is a lot more interest in that sort of higher risk end, which has a greater benefit to New Zealand.
New Zealand Immigration Minister Erica Stanford there speaking to our colleagues Sherry Ahn and Heidi Stroud-Watts. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
Australia's central bank is expected to keep interest rates unchanged today, waiting out an election campaign and to assess the economic impact of Trump's tariffs. Bloomberg Economics' James McIntyre is with us. James, in a way, it's kind of easy for the RBA to go on hold today. It keeps it out of the election cycle. But what are the factors here that are holding them back right now, and when might we see the next move?
Yeah, well, look, that's right. The RBA had always said that it was going to be a gradual pace of monetary policy easing, that it said not to expect back-to-back rate cuts, and right in the middle of an election campaign, staying above the fray, that's a welcome place for them to be. In terms of what's allowing them to get there, the labour market is one of the big pieces in particular. Even though inflation has come back and we've seen it return back into their target band, it's pushing up real interest rates. That labour market remains exceptionally tight. We saw a weird jobs number. Looks like a bit of noise, a lot of jobs lost in the last outcome, but the unemployment rate remaining rock steady, indicating that there is still quite a bit of firmness there in the labour market. We want to see that ease to get them to really rush on further cuts.
James, Rebecca here. I'm just wondering how you see tariffs figuring into this. It looks like Australia may avoid some kind of big impact, but there will, of course, be spillover effect into the Australian economy.
Look, that's right. Australia is not going to be the main target for tariffs. We run a trade deficit with the US. We're a major strategic and security partner. The types of things that the administration is trying to encourage other countries to do, like beef up their defence spending, we're not only doing that, but we're also paying for a lot of upgrades for the US to pivot some of their military assets as they look to take up a firmer stance against China within the Pacific. So we're not likely to be, we're doing the right things, but we also don't have major export concerns with the US. Steel, aluminium, they're some of our bigger exports, beef as well. On the steel and aluminium, they won't really matter to our industry. Beef, that's a bit of a challenge or a problem, but we can also set that through. So what really matters for Australia out of the Trump tariff scenario is how it might impact our other major trading partners, especially China and Japan. And for those, it's not just about the impacts, it's more about how their policymakers respond. If we get really robust stimulus and policy support to offset the impact of tariffs, say from the Chinese government, that's a really big net positive for Australia's economy.
Of course, there's a risk to growth posed by this sort of thing as well, and I raise it in the context that it's kind of anemic in Australia right now. It's really only government spending that's keeping the growth machine running. Is this a consideration for the RBA?
It is, and we need consumers to step up and begin opening their wallets. So we had consumers in hiding for the last 2 years. In per capita terms, spending was going backwards, but because we had a big migration boom, it actually kept the tills running over for retailers and the other side of consumer spending. And government spending was a major support to the economy. Now, non-mining firms, business investment, what they're telling us in the CapEx survey is that they're going to unleash a record level of business investment this coming year. They'll only do that, though, if they feel confident enough. And this is where the corrosive impact of tariffs and the policy on economic economic policy uncertainty that's coming from the Trump administration could be such a worrisome trouble point for the Australian outlook, and why the RBA really needs to wake up those consumers, get those wallets open again, and rate cuts are going to be required to do that.
All right, Bloomberg Economics' James McIntyre there. That RBA decision due at the bottom of the next hour, and we'll get a press conference from Governor Michelle Bullock as well. Let's take a look at how markets are tracking, specifically futures ahead of the open in Europe. Euro Stoxx futures currently in modestly positive territory at the moment, reflects some of the enthusiasm that we're seeing in the Asia Pacific at the moment. However, S&P futures, Nasdaq futures currently in negative territory as we await Liberation Day, April 2nd, 3 p.m. Eastern Time. That's when we get all the news on the next round of tariffs. That is it for the China Show Insights with my colleague Heidi Straub. What's up next? Stay with us.